In today's show, I want to look at where Bitcoin could potentially bottom. I also want to give you guys some perspective on the current conditions of the market and specifically the Bitcoin price to work out exactly what is happening in terms of whether Bitcoin's going to bottom in 2022, whether we've already bottomed, whether we're approaching a bottom, and just try and provide some clarity on this because I'm getting a lot of questions like, is it time to start averaging in? Is the bottom in yet? And I think in this video, I can offer some clarity over what my personal strategy is as well as what my outlook is on Bitcoin, because as we know, Bitcoin tends to lead this market. And when we do look at altcoin performance and when we verify our investment thesis across the market in general, it does make sense to start with Bitcoin because that is generally the market leader from cycle to cycle. And what better way to start this video than look at the previous drawdowns from cycle to cycle? So looking at 2013, 2017, and 2021 and seeing where we currently sit in terms of the major drawdowns. And we can see that if we take the top to the bottom of the cycle in terms of the weekly candles here, we can see that we had an 86.6% drawdown in 2013. Going across to 2017, we had an 3.97% drawdown in the Bitcoin price. And then if we go across to 2021, we can see that we are currently sitting down minus 77.41%. So what we are seeing is a linear decrease in the severity of Bitcoin drawdowns from 86 to 83 to 77. So it is getting smaller and smaller and smaller, but that is not factoring in whether this current drawdown could actually keep extending. And I do think we're sitting in a very interesting range because we broke down past the previous 2017 all-time high of 19,200. And we seem to be heading towards this next key level, which was the first lower high that Bitcoin made before its successful breakout in 2020, which is sitting at the 13.8 to 14K level. And currently we are hovering in this zone. So I think the question on a lot of people's minds right now is, are we going to get a bounce from this zone? Could we potentially break down and look at even lower targets like 8 to 10K? Or are we just going to rebound and go on our merry way into 2023 and beyond? And I think I can answer this question by offering you guys a little bit of perspective on where we currently sit in the market. And that's my goal to bring this information to you guys in today's video. This video is jam-packed with alpha and value. So hopefully you guys do enjoy the show. Smash the like button, click the subscribe button if you are not already subscribed, because there are some very, very interesting bits of statistics in today's show. The first statistic I want to look at is the total crypto market value. I think it's very important to acknowledge that throughout history, the total crypto market value has been increasing over time. And we never really see in Bitcoin's history, or crypto's history more specifically, more than 2 years in a row where the crypto total market cap hasn't increased. So we can see that generally when we spend 2 years below the previous high, so 2013, the market cap was 10 billion, then it reached 5.7, then it printed a new high. Very, very similar thing happened again, except you added an extra year. So we had the 590 high, then 128, then 190. So 2 years later again, we see the big rise past the previous all-time high. And generally what crypto's been doing in terms of its total market value is progressing in an upwards fashion over time, because although we do see these drawdowns and sometimes they are multi-years, in general, the trend is only one way. So if you've been investing throughout history in Bitcoin, and I know a lot of you haven't, I know a lot of you probably entered closer to the top because that's generally when more people get into the market. That's just the law of human psychology. But if you had been investing in Bitcoin the whole way, you'd still be significantly up. And the same goes for the quality assets like Ethereum and even some other ones like Doge and ADA as well from the previous cycle. However, I do think it's important to note on the topic of altcoins that, of course, as we know, not every altcoin is going to survive. The onus is really on us as investors and analysts to research and work out which projects are going to survive. And I say this because there is a little bit of a misleading data in when you look at data like this, because it shows that the overall crypto market value is increasing. You'd assume most assets increase, right? But the answer is actually most coins end up going down because there's not room for 100, 200, 300,000 altcoins in this market. So what you're going to see is particular altcoins, particular narratives are going to perform really well, but most are going to end up trending to zero because there's simply not enough room to sustain, at least not yet, 100, 200,000 altcoins, because liquidity gets siphoned off in that when that occurs, and you end up getting a situation where only a few end up surviving. So although this does show us the overall trend of the crypto market value, it doesn't show us the amount of kind of artificial liquidity that came into the market and very quickly left. And that's why there's many tokens that maybe you're even holding that are significantly down, because it's just unsustainable for crypto to have that many projects. And eventually we do end up seeing typically a rotation cycle to cycle back into those majors like Bitcoin and Ethereum, etc. Many people are also calling the market dead on social media, though. Like, we've seen the social mentions of the word dead on Twitter and other social media hit almost its all-time high. But as Santiment said, ironically, a capitulation when the dead mentions reach their all-time highs. Historically, when markets rebounded, they have tracked the Bitcoin price over time, over the last couple of years, with the amount of mentions that the word dead gets on social media. And funnily enough, when people call the market dead, that tends to be when we get a rebound. And Alex Becker did say it's insanely important to realize that crypto is not dead. The Ponzi unsustainable market, the terribly over-leveraged businesses are dead, but the price of the coins is irrelevant to what this tech can do for humanity in the future. I think that's very, very, very important that we don't lose our way looking at price and getting too concerned with price, because although it does hurt in the short term when we have cascades like we've seen recently off the back of FTX and earlier in the year Luna, it is very important to note that the fundamental need for crypto in society is at its all-time high, and the tech, in fact, it hasn't gotten any worse. It's actually gotten better, and there's been more development over time, and there's been more players that have come into the market and adopted crypto over time. So although the price is down, the tech hasn't changed, and if you actually look at adoption, you can make a strong argument that it's at its all-time high. And that's not in terms of users, that's in terms of the sheer amount of corporations and institutions taking notice. For example, we had a JP Morgan announcement recently. We've had Goldman Sachs announcements. We've had a MasterCard partnership starting to accept Bitcoin payments, Visa as well, BlackRock offering certain Bitcoin and crypto services to clients. We've seen all of these major institutions come in. Now, let me ask you the question, very, very simple question. If these announcements that we've seen over the last few months, I mean, you could even argue Polygon Matic is another example of this, announcing Facebook, Reddit, Stripe, Disney partnerships. If these big announcements had happened during the bull run in November 2021, maybe even May 2021, what do you think would have happened to the Bitcoin price? I mean, the only logical conclusion I can come to is that Bitcoin would have exploded. And if we did see the amount of adoption we're seeing overall and progression we're seeing in terms of the tech in this space back in 2021, then, I mean, the price would have just exploded. But the thing is, in a bear market, good news is absorbed because there's sell pressure. And although you're getting good news after good news after good news, that market isn't exactly reacted. That news isn't reacted too well by the market. But when you get bad news, like the FTX situation and rumors like we're seeing now of a DCG, like Genesis collapse, and rumors about the Grayscale trust being liquidated, that stuff really hits the market because the market is much more receptive to fearful information. By the way, just on DCG, I don't necessarily think, and this is just my personal opinion, that they'll be forced to liquidate the Grayscale Trust. I think they're separate entities, and I'm not a lawyer, so I'm not too well versed in the legal structure. However, it appears to me from what I've read that if something did happen to Genesis, that it would be an enclosed event, and although that would result in liquidations, I wouldn't be panicking in terms of a massive Grayscale liquidation event, but that's on another note. However, we still have seen that affect the fear and greed index, and I don't think you need a genius to point out to you that the amount of fear in this market right now is very high. And although we are seeing extreme fear on the fear and greed index, if you just scroll through Twitter, you'll already get the picture. The amount of people calling the market dead, the amount of people panicking. This is really, in my opinion, what I would describe as peak fear since really I've been really since the whole year. I think this is like the most fearful I've seen the market the whole year. I was going to say it's the most fearful since I got into crypto. If you guys don't know, I got into crypto in 2019. I do think, though, there was a period in 2020 that was more fearful than this during the COVID crash. So I was going to come out on a limb. That's why I paused to say that this was the most fearful I've seen. I think maybe 2020 was more fearful, but this is very close. And overall sentiment in terms of negativity for a long time, this is comparable to 2017, 2018. And although I wasn't actively participating in 2017, that's generally what I've heard from most insiders in terms of the severity of this bear market's sentiment. So let's just take a step back for a second and look at some perspective, because I do want to answer the question whether I think there's a Bitcoin bottom soon or whether the bottom's in. But we do need perspective before I can answer that question. So I think it's the first thing that's important to acknowledge is that for the first time since March 2020, over 50% of Bitcoin holders are now losing money on their position. In 2015, the number of holders losing money on their Bitcoin position reached 62%, and in 2018, it reached 55%. We're currently sitting at 52%. So when we look at many indicators historically that have alluded to bottoms, or at least alluded to the amount of holders that were underwater, we're kind of getting a consistent trend here, and that is that on most metrics, in terms of total drawdowns, we are now getting into territory where this drawdown is comparable to 2017. When I say comparable, I mean comparable in terms of percentage. Obviously, since the market was a lot bigger, the dollar fall off has been more, but in terms of percentage, we are starting to encroach into that territory, and we can see that given the current fact, given the current amount we've drawn down. However, we can also allude to that point on the total Bitcoin historical in-out money chart, which suggests that most holders are down in their positions. And I think Ran even said the other day that 90% of crypto participants, not Bitcoin exclusive, are now down in their positions. And if that data is true, that would honestly make sense to me, because you guys have to remember how the emotion cycle of crypto works. People get in at the top and they get euphoric at the top. And then when the market starts coming down, that's when they start selling. And the way to actually beat this game long term is to do the opposite of that and not follow the herd. And when the market is going euphoric and buying in, that's when you ladder out. And when the market is going panicking and worrying about lower lows and starting to get really, really scared, that's when you start to ladder in. And I think that's the argument for starting to ladder in now. We'll get into DCAing in a few minutes. That's my final segment in today's video, what my DCA plan actually is in terms of if I'm buying or not. But in general, if you just do the opposite of the market, that's, how you beat retail at the end of the day, because retail ends up losing most of the time in crypto. And I would say that most of us are retail. Okay, I work in the industry, but to some extent, you could call me retail. To some extent, you guys are retail. The way we beat this market as retail members is to not think like retail. It's to think like a VC. It's to think like an institution. And that is something that I've worked really hard on cementing my own mentality as. And I think for you guys as well, starting to adopt that mentality is extremely, extremely important. And that's going to save you a lot of pain long term. So Will Clemente did a thread that I think offers some amazing perspective, and that's the 4 charts that he uses to explain why he thinks Bitcoin is fine. The first chart that he shows is that long-term holders are actually doubling down. So despite holders being the most underwater they've ever been, long-term holder supply is at an all-time high. So the people that have been holding Bitcoin for quite some time continue to stack Bitcoin. So we're seeing most of the sell pressure coming from that small percentage of the market that isn't actually a long-term Bitcoin holder. So maybe that alludes to the fact that retail, once again, to my previous point, they're the ones that panic and they're the ones that result in negative price volatility, because they're not the ones with conviction. And the ones with conviction, they're actually doubling down and continuing to stack. Number 3, blocks continue to be added. So Bitcoin continues to add blocks, which is obviously a positive sign as well. The active number of addresses is making higher lows. So although the number of active addresses for Bitcoin has come down, it is still continuously moving in an upwards direction. And I think that is a positive overall for Bitcoin. So the next thing I want to do is look at the past drawdowns and look at how maybe we can compare those drawdowns to the current drawdown to get some perspective on where we sit. 2014, we dropped 61% year to date. 2018, we dropped 72% year to date. 2022, we've dropped 66% year to date. So on my previous point that I made before as well, we're starting to get those indicators that we're reaching a similar level to 2018 in terms of percentage severity of drawdown. Benjamin Cohen also exemplifies this on his Bitcoin market cycle peak ROI chart, which shows the Bitcoin bear markets mapped against each other. And we can see that the green is the current Bitcoin bear market and where we are currently sitting in terms of the ROI chart. And we can see that potentially there is a little more downside if we look at this chart. However, this is the kind of where we're currently sitting in terms of Bitcoin's ROI. This is probably the most interesting stat though that I have in this segment of the video, and that's that Bitcoin's 77% drawdown over the last year is its largest since 2017-18, and at 364 days is now the second longest, longer than 2017, decline since 2013. So we are currently in an extended bear market. It's funny that people were calling the last cycle an extended bull cycle. Well, I guess the time frame also similarly has mapped out across the current downtrend we've seen, because we have seen the second longest downtrend since the 2013-2015 decline of 410 days. So if we look at a time frame and we want to use the 2013 decline as maybe a benchmark for how long this bear market will be, then we can see that Q1 2023 could potentially be a bottom. Now, obviously, the macro is very different now. We're in a quantitative tightening period. We've seen a very severe rate hike cycle off the back of really all-time high money printing. That was very different to 2013, more of a QE environment, more of a softer economic environment, easier for Bitcoin to capture value in that environment. That's why potentially I think this bear market could be longer, and that's actually okay. It's okay if it's longer, because it gives us more time to position ourselves, gives us more time to accumulate. But now we are actually starting to exceed the number of days that this bear market has lasted for. So also, I just want to say shout out to you for actually sticking here, because you've just survived what is approaching the worst crypto bear market in history. Dollar-wise, it's the worst bear market in history, but we are now approaching, in terms of duration-wise, what will be the worst bear market in history. And you're actually here consuming content, wanting to learn. I think that's like, you got to give yourself a pat on the back, because that's what legends are made of. That is, I know it's cliche. I hate saying this because you see it on social media, but millionaires really are made in the bear market. And I don't like saying that because a lot of people say it. It's become a bit cliche these days, but it kind of is true. That if you're sticking around now, your chances of succeeding next cycle have just doubled, tripled, quadrupled compared to just jumping in at the top like a lot of retail is going to do. You guys next cycle are honestly going to be the OGs, because next cycle you're going to get a bunch of people jumping into this market that are essentially very retail orientated, maybe what you were last cycle, and you're going to now have a responsibility to educate these people on the crypto market, and you guys we're going to feel like real OGs next cycle when retail comes back. I actually think about that sometimes. It's going to be pretty crazy in my opinion. So let's look at the previous bottom and map it out to how this bottom is currently looking, or how a potential bottom is currently looking, because there's no affirmation whether the current formation is a bottom. But very interestingly, in 2018-19, when we did see that bottom start to form, there wasn't this crazy wick down and this crazy capitulation candle I think a lot of people are expecting. I'm hearing a lot of rumors now, Bitcoin 5, 4K, quick wick, bang, straight up to 10K. I think that's very hard to predict, considering we've seen previous bottoms actually result in a slow bleed and then a buying impulse wave followed by a slow grind up. And that's the previous cycle bottom. That's exactly what happened. We had the peak selling that happened with an extreme spike in sell volume. Then we saw a slow bleed, then a buy impulse wave, and then a slow grind up. But this is the very interesting part about this. We can see the high sell volume here resulting in a selling peak. If you actually go back and you map previous selling peaks over the last 2 years, using Coinbase as the dictator for this, then you can see that historically, it's actually been a pretty good time to enter when sell volume has peaked. We can see it peaked in 2020, it peaked again in May, it peaked again late in September this year, or October this year. And we could, actually no, that's November, because that's just around the FTX period. It's hard to see the timeline here. But every time that we have seen that sell volume push up into that all-time high territory, we've seen a bounce. So it doesn't necessarily mean now is when we're going to get that bounce, but it does show us that historically it's been a pretty good entry. I'm at least judging by the Coinbase liquidity. You can cross-check this with other exchanges, and I highly suggest you do so. Although the Binance volume can be a little bit misleading because they recently changed their fee structure, and we've seen, and obviously we've seen a lot of people come over to Binance from other exchanges recently as well. So the chart looks a little bit different there. Coinbase being a pretty retail-focused exchange gives us a little bit of a sentiment into how retail likes to trade. So I think that's quite an interesting chart to look at. Now, the other thing to note is the severity of this current FTX situation. And I think the first thing to note is that, yes, the FTX situation is very, very bad, what we've just gone through will be industry shaping, in my opinion, especially from the regulatory side of things. I think that now more than ever, this industry is calling for regulation. Now more than ever, institutions need clarity over the future of their investments, because why would an institution trust this market necessarily when they're investing in something that is poorly backed by legislation and could potentially result in exploitation, like we saw with FTX? Many of the top big investors that invested in FTX were actually burnt by the FTX event. And I do think that calls for regulation. However, the thing that I've been doing recently is comparing the FTX situation to previous Black Swan events. I think one that we can compare it to is Mt. Gox. And what I affirmed by looking at this data was, on a relative basis, Mt. Gox was actually much worse than FTX. And if Bitcoin can survive Mt. Gox, which was 4 times as severe as FTX on a percentage basis, obviously the shortfall in terms of dollars was less because the total crypto market capitalization was a lot less back then. It's still 4 times greater than the FTX loss relative to market cap. So if Bitcoin could survive that, it's definitely going to survive this. And if anything, as I alluded to before, the regulatory shift that we may see, let's say Q1 next year, Q2 next year, as we start seeing these bills, that may actually result in a positive inflow from an institutional standpoint, because a lot of institutions are standoffish when it comes to the crypto market right now due to the lack of clarity over regulation. That actually may be a positive thing. Now, it can be a negative thing. I do expect there to be a lot of drama. It's going to be a very busy Q1 2023 as we start seeing these bills and we start getting more information on how they're going to regulate DeFi and what's a security and what isn't. It's going to be a bit of a shit show. It's going to be a pretty crazy few months. I just hope, and it might even go on for years, but I just hope by the end of the process that it ends up being a net positive. And I do think there's a strong potential that ends up being the case. But in relative terms, this FTX situation is not actually as bad as Mt. Gox. However, we are starting to see a lot of people capitulate, despite maybe it not being as bad in terms of a percentage drop. It is still pretty bad, don't get me wrong. I'm not discounting what happened to FTX. I think it's horrible. What I would discount, however, is the crypto involvement in the FTX debacle. The FTX debacle was created by human greed. It was created off the back of centralization, and it basically had nothing to do with the underlying tech of crypto itself. Sam could have scammed a million foodies over cookie sales for all I care. Like, it could have been anything. It could have been a big real estate ploy, but he just used crypto as a proxy to execute what may or may not have been a premeditated ploy. I don't want to say anything too rash because we don't have all the information, but crypto was the proxy because that was the easiest way to make a lot of money very quickly due to the lack of regulation and due to the amount of speculation and hype, retail hype and money coming into the space. It was kind of the perfect storm to run a scheme. And although it did affect crypto in the end, it did affect prices in the end, it's very important to distinguish that it wasn't inherently a crypto event. It was a human event that actually, if anything, highlighted the need for decentralization, which is the ironic part of the entire situation. But it did result in people starting to capitulate. Mark Cuban unfollowed a bunch of crypto accounts. Frank Chaparro said, anyone else feel like they're done with this space? Kobe, who is obviously one of the most famous and credible people in this space, he said after 10 years, he actually thought this for the first time that this might be the day that he's done with crypto. Tom Brady got rid of his laser eyes. Jim Cramer, I mean, he says stupid stuff, but he said people should cash out of crypto while they can. Peter Schiff used this as an opportunity to latch onto Bitcoin maxis and say that this is a crypto extinction. So we have seen multiple people come out and start to bash on crypto, and many people that are big in the space have started to capitulate. Even Root DeFi, one of the biggest DeFi guys from last cycle, you guys know him for covering probably UST and the Terra stuff quite heavily. He came out and completely flipped his stance. And this is not something that's isolated to Root. This is something that's happened across the industry as a whole. It's people, it's influencers or content creators just switching their stance. And he said he can't think of a better way to this is February 19th, by the way. This is absolutely hilarious. He said he can't think of a better way to level up than to invest your money and time into crypto right now. That was Feb, basically the top of many altcoins. He said DCA into fundamentally strong tokens. Stay away from get-rich-quick Ponzi's unless you want to gamble. If you have a long-term mindset, success is inevitable. And then he's flip-flopped just 6 months later and said DCA is the biggest meme in crypto. Mind you, he said DCA into fundamentally strong tokens. A few months later, he's saying DCA is the biggest meme in crypto. You'd be down if you DCA'd into Bitcoin for the last 3 years. Imagine for a safer asset, what doing this with shitcoins would result in. Like, you'd be down 99%. No point in DCAing until an uptrend starts. Now, let me just pick this apart. The reason I want to pick this apart is because I think this is a very effective way of me sharing my views on whether it's actually the right time to DCA. And that's the question you wanted me to answer from the very start of the video, to be honest, whether Bitcoin's bottomed or not. I know we've kind of gone through a lot of data and I haven't answered the question. So this was the perfect time for me to answer the question. It's actually to use Root's tweet as an example, because this is pure capitulation. Okay. The first thing I want to pick apart is the no point in dollar cost averaging until an uptrend starts. Now, this statement is absolutely ludicrous. And I think a lot of creators are starting to echo this statement online. And I'm also seeing it amongst retail. And that's, why would I DCA now? Why would I average into the market when I could just wait for the bottom to be in and then I'll buy? Oh, I've got a plan. I'm going to wait for the market to resume an uptrend. And then when it's uptrending, then I'm going to buy in. Yeah, because, I don't want to buy in during a downtrend. It's catching a falling knife. Don't catch a falling knife. And you hear this all across Twitter. Don't catch a falling knife. Wait for a bottom. Invest once we have confirmation. Look, that makes sense to some extent, especially if you're a TA guy and you're very switched on with indicators and you have a good trading system. I guess you can wait for the bottom indicators. Actually, at the end of the show, I'm going to show you my 3 bottom indicators as well. I know it's a long show, but there's a lot to talk about, and I will show you those 3 indicators. But a lot of people say, let me just wait for the indicators, then I'll average in. Here's the problem. The problem is, okay, you can wait for an uptrend to start. The problem is, by the time the uptrend starts and by the time we have a confirmed uptrend, it's likely that you've already missed the biggest move, because the biggest moves tend to happen from the bottom, and confirmation may be months or 3 or 4 months from the bottom. And that could result in a 300% move in altcoins. So, okay, you might miss the move on alts. Some people might make the argument, I'd rather buy in higher and get a confirmed move than buy in at the bottom. And that's a fair enough argument. But here's my issue. It's that fake outs exist. Bear market rallies exist. We saw one a couple months ago. We're going to see many, many more. People are going to start to get hyped. People are going to start to get back into the market and flood in. And people are going to think that's the beginning of this elusive uptrend. And the problem is, you can wreck yourself time and time and time again after investing in uptrends that simply just result in being fake outs or bear market rallies. So it's very actually hard to pick the bottom and then time exactly when the uptrend will begin. But there are indicators that can help us roughly project where a bottom is. But to be completely honest, a lot of them are starting to hit at the moment in terms of the peak fear we're seeing, and in terms of the relative drawdowns versus other cycles. Now, I'm not saying a bottom's in. I'll show you my indicators in a second. But what I am saying is that this ideology of waiting for an uptrend to start, it's stupid. It's flawed, because you're not going to pick a bottom. If you think you can pick the bottom, personally, I think that's extremely stupid. I don't think anyone can. And the bottom that I potentially think can happen, that is just a guess based on a rough range that I feel like it's likely we could hit. And I may be wrong. There's actually no way of telling whether we're at the bottom. So the only real way to succeed is following a DCA plan, but with nuance. Because Root says DCA is the biggest meme in crypto. No, Root, you're the biggest meme in crypto, because you left out 4 very key points, 4 very key caveats. That's firstly that DCA is flexible. You're setting levels where you want to buy and sell more or less aggressively. DCAing isn't just like, okay, it can be like this, but for most people, it isn't just, let me put in $100 every month forever, indefinitely, and never sell. No, that's wrong, because you want to buy more aggressively when the market's low. When you're getting bottom signs, that's when you want to really start pouring in money more aggressively. And then you want to start selling and laddering out and taking profits and being less aggressive when the market's high. Because I don't think DCAing should just be this linear strategy of just putting money in blindly and just leaving it. No, DCAing should involve profit taking, and it should involve ramping up during times of volatility. For example, the day that the FTX collapse happened, I made a very big relative purchase relative to my other DCAs. Did I buy crypto this week? Yes. Did I buy crypto last week? Yes. But my buys last week, they were much bigger than my ones this week. Why? Because I thought the risk reward on those days were better. And most of my holdings since then have actually bounced. So that ended up being the right logic to take. This week, maybe you could make the argument that there's an argument to wrap up DCAs. It all depends on how much money you've got on the side, because it's rare people have lump sums. So how much income you're actually generating, and your long-term outlook. And that's why time frame is so crucial. Root got this completely wrong because he said if you bought Bitcoin every week for the last 3 years, your total return would be minus 8% today. But what he's forgetting is that if you bought Bitcoin every single day for the last 20 years, or not 20 years, 2019 is 2009, sorry, is when Bitcoin, when you can start buying Bitcoin. Let's realistically say 2012, because those first years were a little bit weird and it was hard to buy Bitcoin. So let's say 2012, you could be buying for the last 10 years. And if you were buying over the last 10 years, you'd be up hundreds and hundreds of percents, if not thousands of percents, DCAing into Bitcoin. So he is cherry picking the dates here. He's picked the top to the current date, basically. And the problem with picking the period of the top to substantiate DCA logic is that you're forgetting that DCA is flexible. This point is so important, guys. Remember this, because when the market's low, that's when you want to start ramping up. So I actually want to help you guys DCA. Like that's been one of my goals. I've been trying to work out a way to help you guys do it over the last few weeks. And I decided to start launching portfolios on Nested because what I want to do is I want to build 3 portfolios. I've already built one, but this is adaptive with a longer term outlook. So I would say the outlook on this is 2023. Conservatively, I would say maybe 2024. But what I'm starting to do is build portfolios for you guys. So when you want to DCA, when you decide you want to put in $1,000 a month, or when you decide it's time to be more aggressive, you can actually just come straight to my portfolio and DCA straight in. This is the first one I've created. We're not trying to pick the bottom here. So I'm not expecting this to be green tomorrow. I mean, for all I know, this could be the bottom, and we could see it tick over green tomorrow when it's all up only. But I want to be quite clear on my point here that this is like a long-term portfolio with a multi-year time horizon. And this is something that you guys can DCA into if you like it, and I'm going to create more as well. This is a very base version that I've started with, but you're essentially copy trading, because when I make a trade on this portfolio, you'll get prompted to make a trade on Nested Finance as well. So every time I make a trade, you'll get notified. So this isn't linear. In fact, I've even considered selling some of these for tokens that I think are maybe even better over the next few months. I'm going to manage it actively, basically is what I'm saying. But if you do want to DCA, then this is a good option in my opinion. And there's a link in the description to copy my portfolio on Nested Finance. We are giving away $1,000 to 2 lucky copiers. So if you do choose to copy the portfolio, it's very simple. You just click the copy button at the top of the portfolio, and then you click deposit funds. You can deposit with stable coins from your wallet, or you can deposit with your Visa MasterCard. It's very, very simple. You literally click deposit, click a stable coin, let's say Tether, and then you can set an amount you want to deposit and confirm the deposit, or you can use your Visa card as well to deposit. So it's actually quite simple. You just click add funds, and it'll give you a Visa prompt. But yeah, if you want to DCA into a portfolio, you can do that, and also you can stand a chance to win $1,000 for 2 lucky copiers as well. But as I said, I'm going to create more portfolios. This is my mid to low risk one. I'm going to create high risk ones. We're going to have a lot of fun because yeah, I do believe DCAing into the market is certainly a valid approach. I would highly argue against Root's stance here. I think DCAing is very valid as long as you're taking in the points of nuance that I mentioned on my Twitter. Then I think DCAing can become very, very valid. So let's also go back to the title of this video and answer the question: is the Bitcoin bottom soon? What is the Bitcoin bottom? And I'll kind of just give my subjective opinion on this. This is by no means objective because, as you've probably worked out by now, there's no way of telling the exact bottom in this market. But there are indicators that can help us get a better idea of whether we're at the bottom. Jack Newald, before the whole 3AC event, he asked cryptocurrency OGs how to detect market bottoms. Those OGs reported back to him 14 bottom signals. Out of those 14 bottom signals, at that point, we'd only seen 4. Today, out of the 14 bottom signals that he had surveyed, we have now seen 10. So if we take this as kind of like an arbitrary measure as to how close we are to a bottom, we can see that we are starting to get a lot closer. We've seen big funds blown up. Boredom in the market has reached max boredom. Maybe this is subjective. It could get more boring next year. Cross of the weekly 200. Loss of retail interest, 100%. I give a massive tick to this one. Retail is almost dead. Apart from the occasional tune in to get involved in some drama, it's dead. Active participation. You guys are the OGs that if you're watching now, 30 minutes in, you're incredible. And I think you're going to make it next cycle. I'm being like 100% honest with you. Quiet crypto social media engagements have generally dropped. Disappearance of Web2 integrations. These two, I think you can make the argument they haven't hit because crypto Twitter's been kind of active throughout the FTX thing. Web2 hasn't really disintegrated. And there hasn't been any silence, but many of these other things, fear and despair, industry layoffs, anger turning to apathy, we've seen a lot of those things already start to occur. And Edward Snowden said there's still a lot of trouble ahead. But for the first time in a while, I'm starting to feel the itch to scale back in. And this is something I've been doing. So to answer the question of today's video, what's the Bitcoin bottom? If I had to give a stab, 12 to 14K, that's a stab in the dark, but it doesn't really matter for me because that's not my strategy to pick the bottom. My strategy is to actually DCA around periods of general bottoms. So taking like a rough 5-month period where a bottom is likely to form, DCAing within that realm. And I do think we're currently approaching that realm. And that's why I would kind of agree with Edward's sentiment here that scaling in is something that you can look at doing. And now more than ever, I think it's become more attractive as long as you've got a solid income to sustain buys. I don't think there's a problem with DCAing if you've got a sustained income. I think the problem people have with DCAing is they DCA, and then they run out of money. Well, you're not really DCAing then, because when you come up with a DCA plan, it has to be measured in terms of future income. It has to be scaled. So you have to work out your future income, divide it by the amount of purchases that you'll be making, and then adjust for volatility. No, a lot of people don't do this. They just start DCAing. They pick $1,000 a month. They realize that's actually too much. Then they lower their DCA amounts, but then they've actually ended up averaging in higher than the current levels because they've been putting more percentage of their net worth into higher crypto prices. Now it's lower, they're DCAing less. It actually should be the opposite. And if you're in that position, that's okay. You just kind of have to accept that maybe it wasn't the optimal strategy and just come up with a strategy that is optimal going forward. And the other thing I just wanted to look at before we head off here is the Wall Street cheat sheet and try and kind of use this as a gauge for where we could potentially be sitting. It is hard to tell, but Alex does think we're currently hitting depression. This is quite hard to tell. I think we're certainly past anger. Anger is usually a very rash response. I would say we're somewhere between anger and depression. I'd say we're somewhere in this zone. There's also a chance that this turns to disbelief very soon. I think my prediction of a Q1 to early Q2 bottom is still kind of, in terms of its duration, is lining up. I still kind of subscribe to that theory. But just because I think that we might not bottom till next year, which is my belief, by the way, doesn't necessarily mean I'm not buying, because there's two very different things: me thinking something will happen and me thinking and something actually happening. And I've kind of prepped for both scenarios of if we are hitting a bottom Q4, then I want to maintain enough exposure to upside, just as I have enough exposure to stablecoins and non-crypto assets that could potentially become useful if we go even lower. So it's all about planning and strategy. I've been preaching this for like 6, 7, I mean, the whole time I've been at Crypto Banter. What's that now? Almost a year. It's coming up with a sustainable strategy. Look, if you've been sticking to one, then there's no reason to veer off that path now. In fact, you'd want to be sticking to those rails as strictly as you ever have, in my opinion. Obviously, not this is financial advice, but in my opinion, it really pays to adhere to that strategy when the market is when the market's down. And Alex, if we really are in depression, then that's a good thing, because after depression comes disbelief, and after disbelief comes hope, and we're all going to be rich. But this is also a very drawn out cheat sheet. I also think when people look at this cheat sheet, they have to recognize that anger to depression could be a year. Depression from disbelief can be a year and a half. Like this isn't just like 1 week, 2 weeks. It's like, this is something that plays out over a long time. And it's only in hindsight where we work out where we are. I just think it's quite a good thing to look at and kind of refer to mentally to work out where we currently sit. So the takeaways from today's video is come up with a plan, have that plan to average into the market, because picking the bottom is very hard. And I would probably stay away from any strategy that involves you picking a peak or bottom. You guys know kind of my 14K Bitcoin level. That was the previous level we broke past in 2020 when we were going to push towards all-time highs. I feel like that's a very key zone, 13.8 to 14. Maybe that's a zone we touch, but it's unlikely it's possible we get a capitulation wick, but many times in history we've seen a slow bleed. be the way that Bitcoin does form a bottom. So I think that's also possible. And yeah, I'm just sticking to my strategy, and you guys can follow a similar path if you want to sign up for Nested Finance or copy my portfolio Nested Finance with the link in the description. Maybe you'll get lucky and win some money as well with the $1,000 giveaway. But that's just an initiative I'm doing to help you guys kind of start getting your DCA portfolios intact. I'm working hard to make some pretty cool portfolios for you guys. So we've just done the one for now, but as you guys know, when I make a trade, you get notified. You can copy that trade. So you'll never be out of the loop, and I will keep you updated every show. That's something I'm going to start doing. So smash the like button if you enjoyed this video. It's extremely long, much longer than I would have liked. Internet, much shakier than I would have liked, but as you guys can tell, I'm not at home. I'm in Dubai. I'm enjoying the hot weather. I was in Amsterdam last week and it was freezing cold. It was like -3. And then I've walked into like 30-degree weather every single day. I'm honestly loving it. Yeah, just going to enjoy Dubai over the next couple of days, and then go home to Melbourne. Excited to go home, see the family, get into more of a routine with the shows. I know they've been all over the place, but that tends to happen when you travel. And also excited to get a good internet connection back because these hotel Wi-Fis aren't exactly cutting it. But yeah, smash the like button if you enjoyed. Hit the subscribe button. I will see you tomorrow in what is hopefully a much, much, much shorter show. Peace out. Come on, show the end screen. There we go. There's the end screen. There's the disclaimer.